hopefully it helps you guys. Well, I know it's gonna help you guys, but let's get into it. So,
Okay. All right. So good morning / good afternoon, everyone. On behalf of YP ATL and Keller Williams Atlanta Classic, welcome to Game Ready, a World Cup networking experience. My name is Brailsford. I am a realtor with Keller Williams Atlanta Classic. I'm also the co-chair of YP ATL and today's moderator. We are so excited that you chose to spend today with us. Our goal today is simply to bring together professionals, investors, entrepreneurs, and community members for meaningful conversation around wealth building, real estate investing, and opportunities here in the Atlanta market. Before we get started, I'd like to take a moment and thank our event sponsor. First, thank you, Rob Foster, for our lender partner, for supporting today's event and helping educate our community on financing and investment opportunities. We'd also like to thank Aleeyah, who's out in the lobby, the insurance club, for his support and commitment to helping individuals and families protect their financial futures through life insurance and wealth preservation strategies. Let's give it up for our sponsors. Now, I'd like to introduce our incredible panelists. Gabbie is our residential real estate expert and works closely with buyers, sellers, and investors throughout the Atlanta market. She brings valuable insight into identifying opportunities, understanding market trends, and building wealth through residential real estate. Des is a commercial real estate broker with expertise in commercial investments, development opportunities, and helping investors understand the broader landscape of commercial real estate throughout Metro Atlanta. Rob Foster is a capital lender who works with investors and home buyers to secure financing solutions that help turn investment goals into reality. He brings a unique perspective on lending, financial preparation, and investment funding strategies. And Aleeyah Sanders is a general contractor with experience helping investors navigate renovations, permitting, construction planning, and maximizing value through strategic property investments. Let's give a warm welcome to our panelists. Okay, so today's discussion will cover residential investing, commercial investing, financing and capital, and construction and permitting. Whether you're looking to purchase your first investment property or expand an existing portfolio, we hope to walk you through with practical information you can use immediately. All right, so let's kick things off with residential investing. Many people start their investing journey with residential real estate, but without knowing where to begin. It can be a little overwhelming. So the first question is for Gabbie. Gabbie, what makes a good investment? What makes a good first investment property?
Okay, so can you hear me? No, is it on? Can you hear me? I'm loud anyway.
No.
So.
Can we turn her up in the back? Miss Toya, can you turn up Gabbie's mic, please?
Right. Okay, can you hear me now? Yeah, okay. So I have, just to make sure I hit everything, but I would say the best investment property opportunity for residential buyers, whether it's first-time buyer or you're thinking about house hacking or really that's probably it, is knowing what your strategy is first, going in and talking to your realtor or your lender and figuring out where you're trying to go. So are you trying to house hack? Are you trying to do long-term rentals? Are you trying to do short-term rentals? Are you planning to live in the property for 2 years to avoid the capital gains tax, things like that, and just figure that out first. And then from there, you want to make sure that you are investing, I would say for a first-time investor, is investing in something that is not going to require a lot of work from you. So things like cosmetic upgrades, and you want to make sure those are fixed because they become big problems later on. You'll want to think about emerging neighborhoods, where are jobs coming, and are they building different areas around like parks and schools, things like that. And that's probably it. Those. Yeah, I know I have some first-time buyers in here, so I do want to say that on your first property, I would say don't look at it as a long-term investment. So if you are, or I'm sorry, not a long-term investment, but something that you are going to live in forever. So think about it as this is just a stepping stone to get into the market and use the equity for it to get your forever home. But this is just a stepping stone.
Okay, thank you, Gabbie. The next question is going to go to Robert. Robert, if someone comes to you looking to finance their first investment property, what financial indicators tell you they're ready?
Okay, so the first one is always credit, right? You need to have at least a 680 credit score. There are products that allow you to go lower, but the lower your credit score, the higher the amount of money you're going to have to put down. So if you want to stay in that the typical range for an investor is 15%. So be prepared for whatever home, land, opportunity you see, whatever that cost is, know that you have at least 15% and then have at least 6 months of reserves. That's when we know you're ready. And along with that, the debt to income, right? So if we're dealing with residential, if you're going that route, right, you need to have your debt to income ratio correct as well. So you're not having a bunch of open loans and now you're trying to come to us and open up a new loan, right?
Talk to them about what DTI means, like define that.
Yeah, so DTI is debt to income. So it's like a formula. So imagine your income is at the bottom. We want to divide your income from the debt, or your debt into the income. And we want you to be able to have money left over. And we know that if your debt to income, and when we do the math on it, if you're at a 51 to 60%, like you only have about 60% of your 60% of the money you make is being spent on debt, and you only have 40% left. When we come in and you get a house or you get some land or you're trying to do a fix and flip, even if it's going to take you 6 months to, everybody says 6 months and I'm going to turn a profit. Even if you think that 6 months is going to work, we're looking at it like, what if it doesn't work out? And now you have this mortgage added to that existing debt. Most people look at an investment as something that if everything hits the fan and it's between your mortgage and your investment property, you're going to let the investment property go. And we don't want you to let that go. We want you to take care of that debt that you've taken on with us. So you always want to make sure that your debt to income is at a stable place before you come to us.
Okay, thank you for that, Robert. So, Aleeyah, the next question is for you. Aleeyah, what property characteristics make you think this could be a great investment opportunity?
Yeah, definitely. So one of the first things that I look at in a property is the bones of the structure. So you want to go in and look at what type of foundation does this property have? Is it on a crawl space or a slab on grade type of foundation? And what type of bones does it have? Is it in good condition? Meaning, is the frame member still intact? Is this house going to fall apart if I buy it? In 20 years it's going to fall apart. That means it's not a good investment. So you want to look at things such as the foundation start at the bottom of it. If it has any cracks in it going up in the diagonal line, that means that it has settlement issues. Settlement issues means that your house is sinking and it's typically not a good investment because in a few years you're going to have to pay a lot of money just to repair it. You're going to have an endless pit of repairs. And you'll see those cracks, towards the foundation and around the windows, especially the windows and doors. You're going to see that diagonal crack. I would typically avoid it. Also, what I would look at as a good investment, have your contractor run 2 different estimates. One estimate for repair costs, how much is it going to cost to repair this entire investment property, and second estimate is to tear this house down and build new construction. Because sometimes it might be cheaper to build new construction than it is to try to salvage this older property, right? So that's 2 separate estimates that I've had that contractor do. And the way you kind of want to tell is if you kind of want to tear it down or not is, again, the bones, look for mold, asbestos, mildew, things like that. typically you're not doing investment property, you have to go in and make the whole property. But you want to make sure it has good roads. Another thing is, sorry about that. But another thing is look at the lot size too, because you typically if it has a bigger backyard, you can have an opportunity for appreciation. So if there's a bigger backyard, you can do things such as additions. Maybe you want to add another master bathroom or a primary suite to the property, right? A lot of older properties they don't have primary suites, so look at the lot size. Also look to see if zoning allows for an ADU to be built on the property that also appreciates its value. Thank you for the question. Yeah, ADU. So ADU is an additional dwelling unit. So that's pretty much like a tiny house that you can build in the backyard or any type of additional dwelling unit.
Okay.
I just wanted to add on to Aleeyah because she was talking about general contracting for a residential buying, especially for first-time investors. I would say to make sure that you have your teams together. So I am a huge believer in each person has their different area of expertise, and you don't want to skip out in any area. So realtor is not a general contractor. So have a contractor, have a lender, have a general contractor, broker, have all of these things in place, and as you deal with people, they'll have other trusted individuals to help you along the way, but you want to have an inspector, you don't want to do this by yourself, and you want to know what you're doing.
Thanks for that, Gabbie. Our next question is going to go to Dales. What lessons from commercial investing can residential investors apply to their first deal?
So I think from the commercial side, it's all about location. Even with residential investing, any investment period, it comes down to location. Where's the property located? And then how is that location going to look in 2 years, 5 years, 3 years, right? So you can buy something here in Atlanta. Literally, it's on a nice street with houses, but the street over is just run down, and you have homeless people on the street. So it's all about knowing your location, where you are, and then how that location is going to appreciate or depreciate, because areas do that, right? Areas get disinvested in. So if you buy a house on a block to where maybe the main employer moved away, that area, the houses in that area aren't going to appreciate because now the main employer moves somewhere else. So it's all about knowing your location, knowing what's going on in that location, and just making sure that you know that.
Okay. So I have a follow-up question for anyone on the panel. For someone interested in house hacking, what's one piece of advice you would give? Would you like to answer that earlier?
So when it comes down to house hacking, my piece of advice would be that go into it knowing that it's not going to be your forever home, right? You're buying it as an investment. And so look at it from the asset point. So even if you don't like the layout of the house, it doesn't matter. You're only going to live there for a year, right? So don't get caught up and be emotional and say, well, I don't like this, I don't like that. Look at it from a business standpoint. And that would be my tip.
My tip again is reserve safety net, because things happen and they happen often, especially when you think you have something in the bag. So always have, again, 6 months of reserves. Be prepared for the worst to happen. And again, kind of what Aleeyah was speaking to, be prepared for repairs. Have a fund just for your repairs, because things will happen.
House hacking is actually how I got started a while ago. Actually, in college, I started with house hacking. And how I did it was, buying a property, moving into it, renting out additional rooms. I didn't have like a duplex or anything like that. But one of the things that I really learned with that is make sure that if you are sharing a property, a duplex, or any type of property, with your tenant. Make sure that you have strong contracts. Make sure you have strong boundaries, because a lot of people will try it, especially if you like kind of live, in that same vicinity. They'll say, can I just, get a deal on the rent, today or this month? Make sure you have strong, boundaries when it comes to that. Make sure they know that it's a landlord-tenant type of situation. And also going back to the layout, it's good to have a separation in there. If you can have a duplex or triplex that you can house at, to have that type of separation really helps with that type of business out there. That's fine.
I am a strategy person, so I'm always going to say understand what the strategy is before. I would agree with Des and make sure the property is functional. Would you put it in it? And if there's a roommating situation, but how is it going to function for a tenant? And the other thing is, again, back to the people have their roles, have a property manager. So you don't have to worry, you don't have to mix the lines with, oh, this is my tenant and I live here too. You have your boundaries already there and the property manager handles all of that.
So the last thing is, when you're hacking, know the guidelines. Know the product that you're using, that you are going to hack your way through. Understand the guidelines, because what you don't want to happen is you use the wrong product to purchase the home, and then you did the hack, and in those guidelines that you signed, there's some sort of recourse for the lender. It is going to be the lender that finds out that, hey, you're using this as an investment, when in the guidelines it thoroughly says that you can't. But there are some things that you can use. So you just have to be careful with the product that you use. Again, the people that you do trust around you as you're doing your hack, just be mindful of what you're doing.
That was great. We're going to move into commercial investing. This space can seem intimidating, but there are opportunities available at many different levels. We're going to start with you guys. What commercial sectors are growing the fastest in Atlanta right now?
So, you guys might not want to hear this, but the fastest section in commercial real estate is data centers. They're popping up everywhere. There was literally a whole convention with hundreds of investors a couple of months ago about investing in data centers here in Atlanta. So that is literally the number one thing that we're seeing on the commercial side. Outside of data centers, industrial and logistics, right? That's fundamental to Atlanta. With having the airport, the rail system, we still move a lot of product that way. Multifamily is kind of cooled down, I would say, back in 22, 23, even the latter part of 21, there was a lot of apartment buildings being built, right? If you guys ride downtown, you see all these new buildings. So we don't have as many apartment buildings being built, but that's still hot because Atlanta doesn't have enough housing, and we don't have enough affordable housing. And then affordable housing. So multifamily is always going to be a good investment asset. And then the quiet one that's kind of making a run right now is retail. And so what I was talking to a lot of investors about a couple of weeks ago is that, you might see locations, I believe like Del Taco shut down in Midtown. We see properties being shut down. But my point to my clients was we have other restaurants coming down from New York City, coming down from Chicago. So when they get to Atlanta, they see the rent prices here, and it's a lot more affordable for them here than it would be in New York and in Chicago. So while our retail businesses here in Atlanta, things have gotten expensive for them, but for businesses coming out of state, especially from those high-priced states, they're moving in. So retail is definitely a quiet one that's coming under the radar, but I would look at that asset class as well. Sure.
So this can be like the franchising, right? So like for example, in my neighborhood, they're building a restaurant for lease. So like, would it be smart to try to do what would you put there? Would you do a franchising thing, or like, how does that work?
Talk to that.
Yeah, so I'm not going to send this under.
Oh, sorry.
But it really just depends on like the business model, what the asset is. And a lot of franchises, they will reach out and they have their own requirements about what their property needs to look like. A lot of them want second generation restaurants. They don't want to have to go in and put in a grease trap and all of that because it's very expensive. So I would just say, from your perspective as an agent, just give it the franchise and see like, okay, what's your property criteria? Like, what are you looking for? What's the location? What's the square footage size that you need? And also ask them like, how many locations are you trying to bring to the area? Because some of them might have like a regional contract and they might want 10 locations across the metro. So I would just say, ask those questions and figure out really what they need their property to look like.
Okay, thank you guys. Robert, what financing options are available for someone interested in purchasing their first commercial property?
So there are two main ones, right? The one we all know, conventional commercial finance. We all understand that. But the most overlooked one is SBA. So using SBA is going to get you a 10% down payment, and most people have a business now. Like, you know, that was the thing. Question?
No, I was going to go ahead and question, so.
Okay. But yeah, most people have a business. And so what a lot of people don't realize is through their NAC or NAICS, how I say that wrong, NAICS number, you can search and find the hierarchy of your designated code. And through SBA expansion loans, you can grow your business. So if your business is at home and you want to grow into a brick and mortar, you want to take over that property like you said that they saw, you can find out where you can now elevate your business up and get into this commercial real estate game. SBA requires you to own and operate 51% of the building. So what does that mean? It means I have 49% of the building I can lease to someone else. So not only can my business go in this building, I can now become a landlord, a commercial landlord, and lease out the rest of the space to another company that may want to come in and operate in this building. SBA doesn't have as strict requirements as people think. The primary thing you have to have with SBA, you have to have your taxes in order. Taxes in order, don't owe the IRS any money. And not that you don't owe them any money, you can actually get on a payment plan. And so with SBA, we want you to at least be on the $500 a month payment plan. So you get yourself on the payment plan, have your 2 years of taxes in order, have your 10% for your down payment, and know the hierarchical order of where your business is and how you're going to elevate or expand your business. And now you have opened yourself up to properties from $5 million to $17 million.
Okay, great. Next question is for Aleeyah. What construction or redevelopment opportunities are investors overlooking in the commercial space?
Yeah, definitely. One of the main things that they're overlooking is adaptive reuse. So adaptive reuse is when you take an existing, maybe vacant building and say if it's a hotel, right? A lot of hotels are going abandoned now because a lot of people don't have money or capital for travel or leisure right now. So if a hotel is sitting vacant, an adaptive reuse may be to transfer that into an apartment building or to an office building, right? And so you're taking a building from one use and transferring it to another use. That typically involves zoning, but a lot of people overlook that. A lot of the different types of adaptive reuse is, again, hotel, office, and warehouse, right? So a lot of warehouses are going abandoned right now, but that's a major opportunity for investors to get into commercial investing, as well as on the construction side, if you want to really maximize your investment, transferring that from one use to another use.
Just to piggyback off of that, another good property type to look into would be old bank buildings, right? Like the retail bank, you have the job market. A lot of those are sitting vacant as well, or they're on the market. So if you're looking at that, a lot of times, I know I have one, it's only $450,000. Like that's what people are paying for houses around the city too. So if you look at the way with that, do you go spend almost $500,000 on a house, or do you spend it on an investment property, take that passive income, and then let that be the money that pays for your mortgage? So they're just on the adaptive reuse side. Old bank buildings is another place that you guys can look into as well.
What do people put the price? What do people, the old bank buildings, what do they make them to?
What'd you say?
So the old bank buildings, what do they like convert them into?
So the one that I have, a food truck guy is actually using the parking lot for his food truck, and he's looking to convert it into like a sit down on the inside.
Oh, wow, okay.
So there, I mean, you have to be creative, but I mean, there's so many things that you can do with old properties. It's just a matter of like, what do you want to do with it?
Yeah.
You can also do pharmacies.
Pharmacy, oh, yeah. That's,
A lot of
yeah.
pharmacies. So they already have the pneumatic system, so you can service multiple people that drive up. Yeah, thanks are great.
Next question is going to Gabbie. Wait, Aleeyah, did you?
Yeah, I just have one more thing to add to that. One more thing that goes overlooked with construction and development, a lot of people just continue with the same types of construction or the same types of design layouts, and they're not creative with construction or redevelopment at all. So another opportunity to really maximize on your investment is to really go in with the design aspect. Get with your contractor and get a good architect, get a good interior designer to really push the design envelope so you're not looking like every other building on the inside or outside of it, and really maximize that investment and really maximize your business. So go that extra mile.
All right, Gabbie. For someone who has only invested in residential real estate, what mindset is needed before exploring commercial investments?
I think I would say that they're two totally different things. It's not even comparable. Honestly, with residential, you're looking at comparable sales of the area or what's coming to the area, but commercial, you're really looking at it as an asset and how much income you're getting from it, how much income the area is getting. So I don't have a lot to say on the commercial side, but it is a totally different mindset.
Okay. Follow-up question for anyone on the panel. What's one commercial opportunity you believe more investors should pay attention to?
So I'll give y'all another property type too. All auto mechanic shops. They are everywhere, and if you look at where they are, they're in prime locations around the city. And so I'm actually looking into this myself, but think about where they are. So there's one like right on Northside Drive, downtown, prime real estate. Don't look at it from the standpoint of this is an old auto mechanic shop. You look at it from the standpoint of what is it zoned? And that zoning is going to tell you what else can I put on this property. So if it has like a mixed use zone, that means I can go in and put retail and I can put houses on this old auto mechanic shop. Now buying properties like this, you'll need to watch out for like any environmental hazards because you want to make sure no oil or anything leaked into the soil. But you want to do that anyway. You have to go through a phase one, or I recommend all my clients, you get a phase one on any, commercial property. But if you look at the long-term value of that property, that's kind of the play there. So I would say auto mechanic shops.
Okay. I think we have a question back here.
Yes, I do have a question. You kind of answered it, but I would like for you to elaborate just a little bit more.
Okay.
As far as the old auto shops, what do you do with the underground storage tank?
Good question. It would have to be removed, and that's where it gets expensive.
Yeah.
It gets very expensive. So if it doesn't have like the underground storage tanks, that's perfect. That's A1. If it does, then you need to basically get like an environmental agency to come out and give you a cost. They're gonna have to test the soil to see if it's contaminated, and then you want them to give you an estimate about how much is it gonna cost to remove the underground storage tanks. But don't let that defer you. It's all about doing your due diligence and seeing what the cost is versus what you can make on the back end of the development.
Gotcha. Thank
I
you.
have a question.
Yeah.
It just came up the other side. It's my bad. What about dealerships? So when someone owns like a dealership or something like that, does say it's like Audi lease from the building, or do they own the building?
It's a little bit of both.
Yeah. Oh, okay.
Yeah, it's a little bit of both. Most of the time they lease.
Oh, okay.
Every now and then, like, if they own the actual land, then they'll build, they'll construct the whole building, it's all theirs. But a lot of times they're leasing buildings.
Okay.
But I want to double down on the mixed use from a lender standpoint. We're looking at the way cities are being developed, especially like Atlanta. They want it to be a walkable city. So mixed use is big for us. We're saying yes to more mixed use.
Because they eat, live, and play type of places.
Yes.
Like,
We want you to
really-
eat, live, and play. That's what Atlanta wants, and that's what the lenders are looking to approve.
Okay, so residential here, but this is something that I would look at. I would say like laundromats or buildings, businesses in the health space like Pilates studios and just things that are coming to these areas that are not necessarily, they're not developed there. So like South Fulton, there's maybe 1 or 2 Pilates studios, but look, girls love Pilates. So,
Shapes body.
they love it. So I would say things like that, but also laundromats. I've been seeing, I'm looking into this myself actually, but I've been seeing a lot of laundromats come that are a little bit more creative, like putting a coffee shop or making it a little bit more aesthetically pleasing for people to come and hang out. And you can cut down your operating expenses because you can make it digitized. So.
So this is I thought about this, but what about condos? Like, are you seeing people investing in condos really in terms of investments or not really?
I don't think the market right now is good for condos necessarily. I feel like they have a lot of HOA fees, they have a lot of restrictions, and Rob is talking more to the lending restrictions on it, but it's a lot that goes into selling and renting, or selling and buying condos.
So would it be worth it if someone, for example, they bought like 4 condos in a building and they rented them out? Like, would it?
It would depend on the restrictions. Like the HOA is going to have restrictions on what you can do with it. I mean, honestly, for residential buying, it's really what's your plan? Like, are you going to stay in there? Are you looking for a city buy? Like, what's your plan with it? But if you're thinking about investing in it and renting them out, the HOA is going to be a factor.
Well, some of those buildings, like, they make you pay like $15,000 for like a rental, like a rent permit. So like, it's just wondering if that's even worth
It makes sense.
And some of them have rental restrictions also. So.
Another point on the condos is like, especially in these older buildings, at some point you're gonna get hit the big fee if they upgrade the elevator system or they need to put something in. That cost gets passed on to the condo owner. And so I would just say be wary of that, especially if it's an older building.
the special assessments.
Yeah.
Yeah, and if the HOA is going to help you, honestly, because everything is taxed.
You have another question?
So my question is for you, sir, Mr. Rob.
Okay.
It would be, how likely are businesses able to get funding for mixed use? So if we wanted to lease spaces on the bottom and have residential on the top, are you seeing that a lot in business?
It's always about comps, right? So again, if you're in the city of Atlanta, yes, because the city's flourishing, things are happening. So we know you're likely to get tenants to rent out, to do business at the bottom, and you're very likely to get tenants that want to live at the top. If you're in Macon downtown, probably not, because there's probably not going to be any comparables that show, okay, this area is growing. You're going to actually be able to fill all these spaces and keep tenants and keep renters. So yeah, it's very dependent on the area and what's happening in that area and the comps around the area. So as a person, whether you're the agent or you're the investor yourself, you always want to look at what's going on around the area that you're investing in.
So are we looking at occupancy rates? Are we looking at gross rent multipliers?
You're looking at everything. You're looking at everything. One thing isn't the total factor. It's the combination. So again, if you got everything trending up, then that's a good sign. If let's say rent went up, but everything else around the area is starting to go down or be bad, like let's say crime's starting to increase, and rent's going up, but then there's also occupancy going down.
Right.
Then yeah, that area is trending down. So we're probably going to start to say no. So it's a mixture of factors. It's never just one thing. I mean, I will say this as an investor, when she talked about like the condo situation, right? It's always about profit at the end of the day, from an investor standpoint. So is all of those risks and fees and everything, if at the end of it you're making enough cash flow, then yeah, it probably is still worth it. But if that's not the case, if there's all the fees, there's little cash flow, and the areas decline, like you gotta say no.
Yeah. Thank you for the question. I'm gonna stay with you, Rob. Let's talk money. Financing often determines whether an opportunity becomes reality. So, what financing products should investors know about today?
Oh, I would say the number one thing that they should know is, again, SBA it is right now. There's a push to get these loans done, and that's coming down from the Fed. They want these to happen, so it's an opportunity zone right now. Outside of that, you should understand DSCR, and that's debt service coverage ratio. That's where we don't look at your income. We look at, again, the rents and the comps around you. Like, truly understand the ratio. And again, find out what's going on around the area. Find out the crime rate. Find out the move-in rate. Find out the Trader Joe's just opened up down the street, right? I don't know if everybody knows that. That's a company you want to follow.
Yeah.
If Trader Joe's is building in your area, you want to start getting property in that area. And it's been proven that I think the percentage is like 200 to 300 or 400% in the 5 years around Trader Joe's, wherever they go. So it's knowing things like that you want to keep in mind. But again, product-wise, SBA, DSCR loans.
While we're on the money topic, how do you feel or how do you analyze borrow, rinse, repeat as it pertains to using the equity you've already established to accumulate more investments or more properties?
Well, again, now we're looking at your track record. We're looking at what you're doing and how you're doing it. And typically, if you're a savvy investor and you're making good moves and the equity that you have is substantial, then we'll be more likely to keep lending to you. We actually prefer those types of people, right? When you come in to one of our programs, whether it was DSCR or conventional commercial, once you come in, we want you to stay. We actually don't want you to go out and use a whole bunch of your capital. We want you to keep borrowing from us and just using 10%, 15% to get your next properties and keep them rolling. We want you to keep getting asset richer, right? We don't want you to be cash poor. We want you to be cash rich. We want you to keep your money and have assets that have equity.
Thank you for that, Rob. Next question is going to go to Gabbie.
Okay.
Real quick, sorry. Go ahead.
Could you elaborate on like in what ways somebody would take advantage of that one? Would it be like tenants on the beforehand side or tentative tenants?
I mean, it can be both ways. So, like for instance, I'm currently looking at a couple of auction sites where they're selling like 1 to 4 units on college campuses, or near college campuses. So it's a lot of college housing. They already have tenants, right? So you're factoring in, okay, if I got 4 tenants, it's rents there $1,500 a month, so that's $6,000 for 4 units. How much is it going to? Okay, then the property is going up for auction at $250K. I can put 15% down and get it. That's what DSCR is. DSCR is just looking at all of those factors, and again, you still got to have your 15%. Have your 15%, 20% if the credit's lower, 20 to 25 if the credit's lower. But if you have a 680 above, 15%, and then we're looking at again how much does it rent for? So again, that was an example that already had tenants. So if it doesn't have tenants, now we're looking at the rental comps in the area.
Very good, thank you.
Yeah, so those are like the two main factors. Now the thing that messes a lot of people up is, we talked about earlier, like declining market. If it's a declining market, sometimes we'll look at that and DSCR might not cover it.
Okay.
Or they talked earlier about what they call them, like condo tails. Like you can't use DSCR. We won't lend to you on condo tails. So if you're trying to convert a hotel into like these efficiencies and stuff like that, we're not keen on those right now. Yeah.
Okay, so then we want to Gabbie. Thank you. What financing misconceptions do you frequently hear from buyers and investors?
May you repeat the question?
Sure. What financing misconceptions do you frequently hear from buyers and investors?
I need 20% down. I need perfect credit. I need to wait for the rates to drop. I don't want to buy here. We're just to piggyback off of the Trader Joe's there. We just opened it. We did not. They did open a Trader Joe's in Peachtree City. So when you're thinking about areas like, oh, this is so far from the city, but then you think about it as an investment opportunity, like Fairburn and South Fulton and Fayetteville, where you're not necessarily that close to the city, but you can use that to get the next house in the city where you'll need a little bit more funds. But outside of the SCR loan, unless you're coming in as an investor, a first-time buyer, you can house hack, and there's plenty of ways to do that. You can buy a duplex, you can buy your first property in 2 years, flip it over into an investment property, and then go do your primary house again. So like loans like VA and FHA, and I'm not going to speak into detail on this because you do need to know what your loan product is, but you can use these for multifamily investments and use it as your first time. VA loans, you don't have any down payment. FHA, you're 3.5%, and now you're making money on your first investment.
I just want to piggyback off something she said real quick. So I think a lot of investors get caught up in, oh, I need to be within the city of Atlanta. And that's cool, but the city of Atlanta is expensive, right? There are other ecosystems like she mentioned Fairburn. I don't know if y'all have been paying attention, but Fairburn has built like 3-4 hotels, like they're building up. So when you start seeing large scale development go up around there, that means that the income in these areas are going up, that the population is there, because a Marriott is not going to put a hotel where they're not getting business. So Fayetteville, another one, right? Peachtree City. What just got put in Fayetteville? Does anybody know?
Tripping.
It's something. Don't answer.
The U.S.
Oh,
Soccer
that's-
Federation. The U.S. Soccer Federation.
The U.S. Soccer Federation. So they took 200 acres, and the U.S. headquarters for U.S. Soccer is in Fayetteville, outside of Trillium.
You're right. Smart on Trail.
So when you think about it, it's like, wait, Atlanta's not the only place that you can go buy and invest and make a good return. And soccer brings a lot of money. Every single soccer team that the USA has is going to be going to that facility.
They're training there now.
They're training there now. So knowing what's going on in your location is key. So I just wanted to make that point. It's not all about the city of Atlanta.
And they're all living in that area. Like
They
all
are.
living in that
They need
area.
housing.
Like a lot of businesses are in the south, like Peachtree City, like the Delta Highlands live in Peachtree City, and like it's just.
So I want to add to that. I went to high school there. So I went to Creekside High School. Okay. Yeah. So I'm from College Park. We were bused to Creekside for Fairburn. So we had this like stigma about Fairburn, especially back then. If I knew what I know now about back then, I would have invested in Fairburn heavily. And another indicator, so Trader Joe's is definitely a big one, right? What I saw in Fairburn was Landmark Private School. As it grew and got bigger, they started buying up properties.
I was just gonna say, like, as you go speaking about that, because I'm also on the pretty side, but thing I realize now, Shannon Mall.
Yeah.
And now it's no Shannon Mall. We got a movie there. So fabric in Union City has turned so industrial. It's just a shock. And it's a surprise.
Oh yeah, and it's so much land out there from Palmetto to Fairburn. It's just beginning. So like I said, it's a great area to plot and plan yourself to be as an investor because they're really just getting started.
All right.
I just wanted to say something real quick because we were talking about these companies like Chick-fil-A, Starbucks, Trader Joe's. They put millions of dollars into figuring out where to put their locations, and they put years into that. So when you see it built, it's like I don't even really have to do the research for you. You did it for me. It's standing right here, and everything else is gonna come. But I was also gonna say to your Fairburn point, I grew up in Mableton. My parents bought a house like 30 years ago for $100,000. And when I drive in Mableton, their townhomes are $400,000. And I went to school in the city of Atlanta, and people would say it's so far away from the city, but I'm close to Cumberland, I'm close to South Fulton, close to Lenox. Like you don't have to do too much to get from Mableton to the rest of the city. And now, 30 years ago, now it's I don't know how much equity they have, but considering what they have and what I see, I know it's something in here. So just be open-minded and creative and think, long term.
Okay. So next question is for the video you guys. How does financing differ from residential and commercial investments?
So we like to say commercial is the wild west because how you get deals done in commercial versus residential is completely different. You can syndicate deals, you can borrow money for your down payment. A lot of commercial deals get done using other people's money. And that's just the lay of the game. So a lot of people think, hey, if I want to go buy this apartment building, I need to have $5 million myself. No, you don't. You don't need to have $5 million personally. What you need is a good business plan, and you need to know what value that you bring, and then you can go find that $5 million because there's so many people that are working. Think about the doctors, your lawyers. They love what they do, but they also want to plan for retirement. They also need passive income. That's your investor pool right there. Because they don't have the time to go find the property and then underwrite it and then do the day-to-day and operate it. So figure out what you're good at and use other people's money to get into your investment and keep going. So I think it's just, and Robert, you can talk to this, so it's just so many ways to get commercial deals done. And I don't want you to think that you have to be a millionaire to go out here and buy commercial property. You don't.
So borrowing money for the deposit of your down payment though, like they just go to a loan to get it?
It depends.
Okay.
Like if you have the money, if you have the 25% that you need, then you can. If not, you can go raise that money and say, hey, this is what I'm doing. Come in and be an equity partner with me. I need $350,000. And you would be surprised about people just being like, okay, cool, what's the business plan? And as long as they understand the business plan and they buy into you, you can raise that money to go get that property.
What about the attorney though? Because usually an attorney would do like, for example, a deal syndication in commercial.
Mm-hmm.
If you have an attorney, that's $12,500. Well, depending on what.
It depends on how you do the syndication. So I can say the 5 of us up here wanted to go in on the deal. We can have a member LLC and not have to get an attorney because we're all friends and family, and that's how we want to do the deal. If I'm raising capital from people I don't know, that's when you need to go get an attorney. That's when you need to go through all the legal paperwork and figure out what avenue you're going to use, whether it's a 501c, 506, whatever investment you're going to use. That's when you bring them in. But if it's just friends and family, you don't have to go that route.
Yeah, there's better to do that though. Because if you don't want to let the laws and things, you want to have everything in order.
Yeah.
So or some people were telling me, an attorney was telling me, a commercial attorney, that there's a deal and you could, you maybe it's $80 million. I'm just making stuff up. Maybe it's $80 million. You need $1 million just to close. You can just raise the $1 million just to close some really big deals, and then you get the rest of the money later.
People do it all the time.
Okay.
Yeah, there's another resource out there too where you don't even have to, go through the other SEC filing or go through an attorney either. It's called fractional.app. You can raise the capital with either people you know, people you don't know, but what they do on that app is they set up everything for you. They set up all the legalities. You just pay $3,500 per year. And basically it's a member type of equity platform. So everybody who you raise funds with, they have equal voting rights, and can kind of contribute to the development as well. But it's a really good way to raise capital without going through all of that. And it's just $3,500 a month or a year.
Okay.
Okay.
The next question is going to go to you, Aleeyah. How can investors financially prepare for renovation costs before they even close on a property?
Yeah, so that goes back to what Gabbie was saying. Make sure you have a team. So go through your contractor, make sure that your contractor knows exactly what you are searching for as far as what type of properties you're going to be looking at, so that they can have an idea of what needs to be done for that property. So say if you have an office build out that you want to do, make sure you take that contractor out to that site visit, make sure you have them walk around the site, make sure you have them take measurements and everything. And what that contractor is going to do is get in contact with an architect during the due diligence process, and together they're going to go over everything that needs to be done, and then write down, make sure they have an itemized estimate that they give you, and in the lender's template to give to the lender before you even close, to make sure that it's fundable, it's within the lender's criteria, and you can actually get it built through the county. That's where our architect comes in handy at, because they already know, what needs to be done as far as permitting, drawings and things of that nature. You already have everything ready to go before you even close. Another way you can do that is just have, your team, your contractor, architect, maybe on retainer too. So any contractor or any visit that you go on, they are already, lined up to ready to go, give you the estimates, what have you.
Okay. And we're going to wrap up with construction, renovations, and permitting. So, Aleeyah, we're going to go back to you. What permits are most commonly overlooked by investors?
By investors, really, no permit should, be going overlooked. What they really should do, like for the process, get with your contractor first and your architect first. Make sure that everything is lined out. So that architect is going to go through, all of the drawings. If there's a sink that needs to be in place, going to go through all of that and draw it out. Then what the contractor is going to do is pull all the permits, for the whole building. Your electrical permits, plumbing permits, of course your building permits, HVAC permits. Nothing goes unnoticed because we have to install everything. We're not going to, forget to install anything in the construction site. So anything we do, we have to have a permit for it. Otherwise, we're not going to get a CO, which is a certificate of occupancy to even occupy that. So really, no permits go overlooked. You really want to start with getting your contractor. Make sure that they're licensed. Otherwise, you want to pull a no permit. You're not getting open in the first place. So make sure you have a licensed contractor, licensed architect.
I just want to piggyback on that real quick. Don't be cheap.
Yeah.
Pay these people, because I've seen it happen to where an investor will think that they can just pay somebody off the street to come run the electrical. Somebody is going to snitch on you. I promise you. Somebody's going to tell, and if it gets back to the city, you're going to have to redo the work. They're going to make you pull all of that out and redo it. Okay? So just pay the money up front to save yourself the headache, the time, because again, all of this is time. Time is wasted. So while you're trying to be cheap, you got a mortgage, you got to pay Rob, he got to get his money. And if the city come out and say, well, we don't have a permit for this, one, they take it all out, now you're paying double. And you still got to pay Rob, and now it's sitting on the market longer, and the market might change. So don't be cheap. Get you a good general contractor, pay them what they're asking so you can get your projects done, and you don't have to go back and forth with the city, because they will put a stop work order on your property, and once they do that, oh, it's over with. If you piss off the city, they gonna make you wait. Absolutely.
Okay, this next question is going to go to Gabbie. What renovations tend to deliver the highest return on investment in residential properties?
Okay, to keep it quick, bathrooms and kitchens.
Bathrooms and kitchens. All right.
Let me say one more thing. Don't go do a custom project in the house that you're going to sell or you're thinking about renting because they're not gonna pay for that.
There you go, that's good. Guys, what improvements add the most value to commercial properties?
Any type of amenities. So if you have an apartment complex, people love dog parks. People love having a gym. People like having, space to go work. Any type of outside space where people can hang out, grill, anything like that. People like to be outside now, and people love their pets. So, yeah.
And then Robert, how do renovation budgets impact financing decisions and loan approvals?
Okay, so the primary thing is that ARV, we don't want your renovation budget plus the cost to get the property. We don't want that to eat up 60% of the ARV is fine. But if you exceed 60%, then we're probably going to deny you.
And ARV is after repair value.
Yes, the after repair, like what you project you're going to be able to sell that property for, or rent it out after renovation.
So what needs to be 60%?
The cost of the property plus the rehab. So you really want it under 60% of the after repair value. But 60 is a pretty safe zone, 60, 65. But once you start getting above that, you're more than likely going to decline.
Okay. So this is the final questions. Before we close, I'd love to hear one piece of advice from each panelist. And since you have the mic, we'll start with you, Robert. What's one financial habit every investor should develop?
If you're going to be an investor and you're going to be dealing with lenders, keep a clean profile. If you have a team of people, have somebody on your team with a clean profile. Great debt to income ratio, great credit score, reserves, ready to go. And then I'm going to add one more. Do your research. Like she was saying earlier, Chick-fil-A, Trader Joe's, Starbucks, private schools, all these different things are indicators, like know where you're looking to invest in.
Okay. Des, what's one commercial investing myth you'd like to bust?
So I kind of spoke to this earlier, but thinking that you need all the money and all the experience, you don't. You need a solid team around you. So if you can figure out what you're good at, maybe you're good at going and locating the property. Okay, cool. Let that be your thing, and then you build your team around that. So you know that you're going to need a good general contractor. You might need somebody that has good credit. You're going to need a good lender on your team. So don't feel like you have to have everything all together before you start looking to build your investment portfolio. You just need a solid team. And one other thing that I'll say, in commercial real estate, it's easier to get larger deals done than it is to get smaller deals done. Because a lot of investors, if you're raising capital, they like to write big checks. And so a lot of my clients will be like, well, hey, I'm looking to go syndicate, this $100 million hotel. It's going to be easy for him to get that money because you have institutional buyers, so you have REITs, you have school endowments, and their minimum check size might be $5 million. They'll say, okay, come back to me if you don't have anything like that. They don't want the little $2 million deals or the $1 million deals. They say, I have $5 million for you. Here's this check. Can you do something with it? So it's so much easier to get the larger deals done than it is to get the smaller deals, but you're doing the same amount of work. The math is the math any type of way. You know what I'm saying? So 2 plus 2 is always going to be 4. 2 million plus 2 million always going to be 4 million. It's easy to get the big deals done. So don't think that you need all the experience and that you have to start small. Just figure out what value you add and then build your team around that.
Aleeyah, what's one contractor tip that could save investors thousands of dollars?
Yeah, definitely. Make sure your contractor is licensed. Check on the Georgia State Licensing Board. Make sure they have general liability insurance, because if something falls or fails on that project, you don't want to be liable for it. Also, make sure they're bonded. You don't want them running out on you. So make sure they have bonding in place. Just one more thing too, make sure on the design process that you don't keep changing your mind when construction starts, because that will result in what's called change orders, which means you're going to be charged double for whatever changes you want to make. So make sure you make up your mind and stick with it.
That's good there. What's, Gabbie, final question. What's one thing every new investor should do before purchasing a property?
Figure out your strategy. Figure out what you want to do. Like, what does it look like long term? And, strategy is most important because you're spending a lot of money.
Okay. All right, well, let's give it up for our panelists. Thank you, Gabbie, Des, Robert, and Aleeyah, for sharing your expertise and helping us better understand the many pathways available to real estate investing. Whether you're thinking about your first time property, your next property, or simply trying to learn more, I hope today's conversation shows you that investing is possible. So my name is Brailsford with Keller Williams Atlanta Classic and YPATL. Thank you all for joining us today.
Well, we're going to have some breakout areas. So each panelist is going to be, well, except for me, I'm going to be with YPATL. But you'll have your own separate areas. So if you're interested in finding more about lending, if you're interested in commercial, if you're interested in general contracting, you can find one of us. We'll show you where to go. But the residential is going to stay in this room.
We'll start here in residential.
That'll help you. All right.
So if you want to find out more about lending, I'm going to take you guys and Robert up to the front. And then if you're going with Aleeyah to talk more about general contracting, you can follow the room, just break off that way. Yep, go ahead.
Thank you, guys. We're going to still stay on here for a little bit of residential breakout, talk about the Atlanta scene as a whole. So thank you guys for joining. Okay. That's good. Yeah. You did a great job. Hey, bye guys.